What's up traders, welcome back. You guys have been requesting that I should do more trade examples that entails the trading process that was used in the previous video. So I'm just going to try and simplify it, make it clear and simple to understand. So let's dive in. So on paper, this is the type of structure that you should be looking for. We have a normal market structure break to the downside. So what I want you to do is to look at this as sell side liquidity instead of a break of structure, especially every time you don't have a dealing range yet. So we're going to wait for buy side liquidity to be taken out too. So once we have both sides taken out, don't look at this as a market structure shift or what supply and demand traders call change of character, because the moment you do this, it's going to force you to see a bullish market instead of a stop hunt. But how we analyze, we frame our trading range from premium to discount after having both sides of the liquidity taken out. So from here, we are expecting a reversal to the downside. So this is when you can use any type of entry setup, because at the end of the day, we're all going in the same direction. So what matters is that you are able to exit in discount, either the 50% level or the first short term in discount or the fair value gap, because it's also liquidity. If you're the incredible Hulk, you can target the external range liquidity. So let's take this to the chart. So we're back on Nasdaq. This is the H1 time frame. So this is the current market structure that we have in front of us. This is the structure that we are looking for, just like you saw it in the previous slide. So we already have the sell side liquidity taken out. So we're waiting for buy side to be taken out to form our profile. So when that happens, we can now frame our range from premium to discount. I personally believe that this is the only time you can try to engage the market, when you have a defined range, to avoid unnecessary losses and confusion. So from here, we need to identify our target in discount. In this case, we do not have open fair value gaps in discount, but we do have multiple lows that also created a trendline phantom. So you understand that we have a bunch of traders that took buy trades from this trend line, and obviously the stops are going to be below the swings, hence we see this as liquidity. So let's see what happened on this trading day in context. So on the 5-minute time frame, remember time and price always. So on this day we had CPI before running the buy side liquidity to form our trading range. They induced buys and ran the stops below the equal lows. They also left the fair value gap. We visited the gap and traded higher into the buy side liquidity, which now formed our trading range. So as you can see, we are also in our silver bullet session, which is from 10 AM to 11 AM New York local time. In SA, that's 4 PM to 5 PM. Now we already have a liquidity run at the top, so now we have to identify our pool of liquidity, which in this case is the trendline phantom that we have identified in discount. So your next move is to identify the fair value gaps that support your entries towards your pool of liquidity. We have one right here, which is the closest one to price. We have another one right here, which exists with the order block. Keep in mind they are both in the premium side of the range. So the second one got revisited outside of the silver bullet session. So if you're a silver bullet trader, you're supposed to be out at this low. And for the incredible Hulk, you can just follow the order flow until you get to the external range liquidity. As you can see, it was met in the PM session, just after lunch hour. Actually, this setup happened many times this week. I'll do my best to share them. I didn't want to make this video long. So that's it for this video, guys. Stay tuned for more content. Until I catch you next time, that's for done.